Hello and welcome back to Argus's Weight of Freight podcast series. I'm Argus freight reporter Michael Connolly, and today I'm joined by VesselsValue shipping analysts Vivek, Srivastava, and Ynes Benotmane to discuss the ongoing Russia-Ukraine conflict and the impact that it has had on global shipping markets. Thank you for being here with me.
Thank you for having us.
Thank you.
Okay, so first let's just get into the tanker markets. What initial impact have you guys seen from the conflict in terms of alterations to clean tanker trade flows and ton-mile demand?
Yeah, so it's had a big impact on clean tanker trade flows. A lot of diesel tends to come out of the Russian ports. Europe gets about 60% of its diesel from Russia when markets are functioning normally. That's obviously left a big hole, sent the diesel price up. Now, ordinarily, that would lead to very high fat, healthy refining margins. That would encourage European refiners to run harder, produce more products. However, that isn't happening at the moment because the gas price is also high and refiners are powered by gas. So that's killed the refinery economics of the European refining sector. So instead of running more and producing more diesel, European refiners have actually cut runs. So we have shortages of all sorts of products, but especially an acute shortage of diesel in Europe. And in the initial phases of the war, that led to a lot of trade flows in from the US East Coast and US Gulf Coast. Latterly, we've started to see trade flows stimulated from the Middle East as well. And it was just starting to happen from Asia when Asian prices for diesel suddenly took off as well. And that started keeping diesel cargoes in Asia. So that trade got choked off prematurely. But yeah, the MRs in particular have seen rates increase as a lot of tonnage has been frantically chartered to bring diesel cargoes and gas oil cargoes from the US and the Middle East. It's mostly focused on the middle distillates at the moment.
Okay, and what sort of impact have you seen on the dirty tanker market?
Hasn't had the same sort of impact on the dirty. Obviously, Russia exports its key Urals grade of crude oil from the Black Sea and Baltic. That saw very limited buying even before the war started, even before the invasion, right from early February. Charterers were, potential buyers for those cargoes were thinking that there's heightened risk here, and they didn't want to be left holding a cargo in case anything happened on the sanction side, on the legal side. So there was very little buying even from early February. With the outbreak of war, we've seen massive war premiums for mid-sized tankers to go into the Black Sea and collect those cargoes, and the Baltic as well. So, for example, TD17, I think it is, which is one of the routes that emanates from that region, seen a massive increase in rates. I think I was just looking at our markets page on VesselsValue this morning. We're showing it up near something like $300,000 a day. However, that is hugely theoretical, because there's not actually that many tankers willing to go to those load ports to collect those cargoes. So while that route is one of the basket of routes that tanker brokers around the world use to calculate an average, just a straight mean average rate for mid-sized tankers, it's probably debatable whether that should be in there, because there's very few fixtures happening on that route. So there is an argument that should be discounted from the basket. There has been a bit of an effect of mid-size tankers experiencing some disruption, diversion. Black Sea and Mediterranean and the Baltic, Northwest Europe, and that's tied up a bit of tonnage and lifted rates for Aframaxes and Suezmaxes. We really haven't seen any impact on the big ones yet, the VLCCs. What we would expect to happen I know crude oil's down today, and it's below $100 a barrel for the first time since this all started. But with oil at or around $100 a barrel, what we would normally expect to see is OPEC riding to the rescue and increasing oil production, especially from the core OPEC Middle East states, Saudi, UAE, Kuwait. However, they've stuck so far pretty ruggedly to their original plan of just ramping up very slowly, 4,000 barrels a day each month. So with output restricted from the core OPEC Middle East states, we would normally expect to see the US respond, and we'd expect to see more VLCC cargoes out of the US Gulf of Mexico. However, that hasn't happened either. US oil production, as I'm sure all your listeners know, is dominated by shale production. which one of the characteristics of it is short response times. So normally you see, quite high sensitivity to the oil price. When the oil price goes up, it reacts very quickly and exports rise very quickly, normally. However, this time, all the producers have been emphasizing, more disciplined use of capital. So it's kind of like, they've been burnt once, they're not going to be fooled twice. So they haven't been that quick to turn on the taps yet. And also part of the reason why US shale production exhibits such rapid response times to the oil price is because they normally keep quite a big inventory of drilled but uncompleted wells, which they can complete at short notice and ramp up production. However, it seems that during the pandemic, the last 2 years, they ran down their inventories of those, so they don't have that short time frame resource there that they can just turn on instantaneously. So the US is taking a bit longer to respond as well. So yeah, we haven't really seen any kind of response on the V's so far. Although I would guess that, maybe second quarter, third quarter, we would see both those regions, the US and the Middle East, start to lift production a bit more. And, that would bring back some demand for V's.
Okay, understood.
Mm-hmm.
So do you see this conflict and the decrease in Russian exports having the potential to stall the broader tanker market recovery that many have been talking about for quite a while and a lot expected to occur in 2022?
Yeah, I mean, when you talk about a broad tanker market recovery, different people in the tanker market will have a different view of the starting point. If you're involved in the MR sector in any way at the moment and you think the tanker recovery is already here, it's happy days. If you're involved in the VLCC market, then, what I said, the Middle East and the US Gulf are taking a bit longer to respond this time. So it looks like it will delay the recovery for V's. And typically in the tanker market, we see trends materialize in the V's first, and then they spread to the rest of the tanker market. So while the small ones, the product tankers, have got relatively healthy earnings at the moment, we're seeing MR rates again on the VV market page. For those of you that want to have a look, in the mid kind of $20,000 a day range for MRs at the moment. It's debated whether we can, push on above 30,000 and beyond without broader recovery in the crude tankers. So yeah, depends on your point of view really. If you're a V owner, it absolutely will delay the recovery. If you're an MR owner, then the recovery is already here.
Okay, so the conflict has obviously led to a major increase in fuel prices, which has widened the spread between high sulfur and low sulfur fuel oil. So what sort of changes in scrubber premiums have you guys observed since the conflict began?
So in terms of looking at the spread between them, both the VLSFO and the IFO 380 have risen almost in unison. So since the beginning of the year, we've seen the IFO 380 rise about 54% and the VLSFO rise about 70%. The difference is more acute for, I'd say, tankers. On the bulker side, you see a general sort of range between 9% and 10% difference between scrubber fitted and non-scrubber fitted. I think as this plays on, we will see a tendency towards scrubber fitted vessels being used more often just because it doesn't eat away at earnings so much. And the increased uncertainty in general has caused a lot of demand and for fuel now, just in case the prices continue to rise.
Okay, interesting. So moving on now to the dry bulk market, how has the disruption of Ukrainian grain exports affected broader dry bulk trade flows?
So Russia is the world's largest wheat exporter and Ukraine is, I think, fifth. And the prices of both of the crops are at record highs as they've paused their outflow. Panamax bulkers will most likely be in high demand as Europe looks to America to source the commodity. It's likely that the US will take the lead as exporter. We've also seen, however, that a lot of Middle Eastern or MENA countries with a high dependence on wheat imports, for example, Egypt, will be likely to source the commodity from the Black Sea region and from Russia, just to avoid a catastrophe in terms of the wheat sources.
Okay, and where do you expect that Europe will source its coal to replace imports from Russia, and how do you expect that this will affect ton-mile demand?
So there'll be a general reluctance to purchase Russian coal, and this will push European markets to source coal from further afield, so places such as Indonesia and Australia, and ton-mile will naturally increase and tighten supply of the ready available tonnage just because the journeys are increasing. And this compounded with the tail end of COVID-19 congestion and delays will probably keep earnings and values at healthy levels for owners.
Okay, and my final question is, which dry bulk vessel classes do you expect to struggle in the current market, and which do you think are better equipped to handle the surging bunker prices and overall instability caused by the conflict?
So I don't know if any vessel types will necessarily struggle, but there will be winners. For example, Panamax bulkers taking the grain exports from the US into Europe, especially the scrubber-fitted ones, will definitely benefit in the short term, and they won't be exposed to the highs of the bunker fuel prices. Yeah, I think for sure. And just within that, Newcastle Maxes, in terms of their fuel economy, will be probably the winners on the back of it.
Okay, that's all for this week's edition of Weight of Freight. Thank you again to both of you for speaking with me, Vivek and Ynes. I really appreciate your insights.